Hi all, this is CMS Sai Kumar Gaud, Head Professional Courses at ISFS and the Faculty for Accounting and Taxation. Today we are going to discuss the topic of accounting principles, the concepts and conventions. Often most ignored concept or chapter you can say, where people just ignore it as a theoretical subject. Please try to understand that this concept of accounting principles is very important for every student to understand before they proceed with any further chapters. Okay, so here today I'll give you a brief intro of these concepts and conventions, what are these principles are all about and how they are useful, how you apply in your subject of accounting, especially fundamentals of accounting. Accounting principles are the basic standard rules and regulations which are made by great accountants who have designed the accounting subject. These principles have evolved over a period of time. This is not a single day development that has happened. Many people have a doubt that accounting is an art or a science. Generally, it's a blend of both. It is both an art and a science as well. The reason it is science is it is based on certain principles, standard rules and regulations. The other part why it is an art is we designed our accounting according to our convenience. So these are the two concepts that one has to understand. Now the science rules and regulations are nothing but the basic double entry accounting rules and regulations which everyone know of your debit and credit rules. But when it comes to the art, the accounting principles will exactly let you know how it became a art. The basic purpose of accounting is to give a true and fair view of the financial statements. And this accounting principles has to be followed by everyone in the preparation and presentation of financial statements. There is no options to you. Of course, in certain things, the options are available, but these concepts and conventions together has to be followed in the preparation and presentation of financial statements. Now, people are not aware of this difference between the principles, concepts and conventions. They feel this as altogether a separate concepts. But please try to understand that accounting concepts and conventions together are known as principles. So principles are divided into concepts and conventions, and these have been evolved over a period of time. It's not a single day development which has happened over hundreds of years of together, or a period of 400 to 500 years. This has been developed. Now coming to the first one, accounting concepts. Concept is nothing but a basic idea upon which our accounting is based. So this concept is as a universal application and has to be mandatorily followed by all. There is no option in this. So when it comes to these concepts, it's a basic assumption on which an accounting is based. So we can assume like this, we prepare accounts for 12 months. Why only 12 months? Why it is not 13 months? Why it is not 11 months? The reason it has to be prepared for 12 months is we have one concept there. So that's how these concepts and conventions will help you to understand the basic rules, regulations that we have to follow in the preparation and presentation of financial statement. If you look at the various books, different concepts and conventions you come across. But among all, 9 are the great concepts that are there on which our accounting is based. Among that, 5 are in general applicable for all. 4 are very specifically applicable for certain things. Let's go through now what are those 9 concepts and conventions that we have and what is this applicability of that concepts in our subject. Is these concepts really important or we need to follow that on a mandatory basis? And yes, compulsory you have to follow these concepts and conventions. There is no options for you. Now in that, let's take up the first one called business entity concept. The meaning of the word entity is separate person. This concept is common for all sole traders, partnership firms, joint stock companies. Maybe by the definition of sole trader and partnership, you might have learned that both are one and the same. Company has a divorce between ownership and management. But please try to understand that when it comes to the accounting is different. Where in accounting, your regular definition of the form of organization will not apply. In the accounting, whether it is for sole trader or it is a partnership firm or it is a joint stock company, compulsory you have to follow this business entity concept, which says that a business should be viewed as a separate person from that of its owners. Here are some examples where in accounting we'll justify how they are separate from that of owners. Business does transactions with businessman, business does transactions with outsiders. The first starting point for any business will be capital introduction. So owner will introduce capital into the business. So that is a transaction which happened between business and a businessman. And the capital is shown as a liability in the balance sheet of the business. So liability is something which we owe. So we owe to the businessman. Undoubtedly it is a long-term liability. It will be paid only when we wind it up. But still it is a liability. You cannot owe to yourself. That's how we can justify that business is separate and businessman is separate. And businessman regularly does the transaction with business in the form of drawings, additional capital introduction, like that. All those has to be recorded. If you feel that both are one and the same, you cannot do transactions with yourself. Like say your right hand cannot do a transaction with left hand. If both the hands does a transaction, it is not with an outsider and you don't record it, right? So business entity concept is the first basic concepts which says only business transactions we have to write. From business viewpoint you have to write, and you have to write in the books of the business. That's the reason you see whenever we write a journal, ledger, when we prepare financial statements on all, first we'll write in the heading in the books of. It is not in the books of a businessman. It should be in the books of a business. So the first concept, business entity concept. Second, money measurement concept. As per this money measurement concept, which says that all business transactions and events should be recorded only in terms of money. Anything other than money will not be recorded, however important it may be. We don't look at the qualitative aspects. We quantitate it, and that should be measured in terms of money. Other than money aspects will not be recorded. So however important a transaction that has happened in the business, however large, however small it is, if it cannot be measured in terms of money, we don't record in books of accounts. If you look at the definition of accounting also, in the definition of accounting it says in terms of money, which means that non-monetary transactions will be ignored. Non-monetary transactions will not be recorded. Then the question arises, what is money? Which is money? We know that money is a medium of exchange which replaced our barter system and all. I'm not talking about that. My point is like different currencies we have, like Indian INR we have, dollars we have, pounds we have. Which is the money? In which currency we have to record? You have to record the transactions in the currency which is in circulation in the country in which you maintain your books, which is called as a reporting currency. Reporting currency in India is INR, Indian rupees and paisas. Like that, if you go to London, it is pounds. You go to America, it is US dollars. You go to Australia, it is an Australian dollar. Now what is currency? What is money? Everything is a money for us. But which money is important is not where you are doing the business. Where you are recording your books of accounts is important. We being in India, we may do business only in Hyderabad, only in Telangana, only South India, only India. And we may do business with other countries as well. But recording should happen only in terms of money. One of the reason and the logic why they have introduced this concept is understandability. Because, like say for example, a 1 lakh rupees. 1 lakh rupees in India, if you take exchange rate of 70 rupees, 60 rupees of US dollars, when you convert, the currency amount will become less when you measure in dollars. It will be higher when measured in INR. So, in India, if you do it in US dollars, the amount will be less and the people will understand it as a INR but not in dollars. They may not value it properly, they may not understand it properly. So one of the concept is understandability. This is called one of the qualitative characteristic, and it has to be uniformly followed by all. There is no option for that. Okay. So this is one money measurement concept. The next one is going concern concept. What is the meaning of the word going concern concept? Going concern concept, it says that business as a indefinite life. Please underline it. It's a indefinite life. It is not your infinite life. There is a difference between indefinite life and a infinite life. Infinite is we cannot. It's unlimited. Indefinite is I know, but I cannot define it. Definite, indefinite, infinite. These are the three words that you have to mind the difference. And it is indefinite, which I cannot define. And no business in this world survives for the lifetime. Every business has an initial stage, growth stage, a saturation stage, then decline stage. Again, when you do some processes, again it will start a growth and all that goes on. But one or the other day, a business has to shut down. Okay, when? You don't ask me, I don't know that. That's the reason we call it as an indefinite life. So that is what a going concern concept says. Because of these concepts, the expenditures that we incur are broadly categorized into two types. One is called a revenue expenditure and another one is called as a capital expenditure. Because if you don't foresee that future of a business, we don't incur a business expenditure which will be useful for lifetime or say long period of time. So in order to have that for long period of time, first you should assume that your business runs for long period of time. If you don't make that assumption, you cannot incur a capital expenditure. A business invests in plant and machinery, land and buildings, which has got long period of time and it will be amortized every year based on the use that we have. That's where the concepts of capital expenditure and revenue expenditure has come up with this going concern concept. Okay, but with this going concern concept, in continuation, we learn one more concept called accounting period concept. As the going concern concept says that our business will run for a very long period of time. How long? Do you know? Don't know. So accountants decided that as we don't know how long we are going to run the business, but many people who are called users of financial statements, which you will normally study in the first chapter, every user needs some information of the business. These are called users of financial statements. Now this business information, only these financial statements will give. So when it is an unlimited life, when they will get that information? At what point of time they have to stop that for that information and check? So what accountants decided, let's do one thing. Let's select a particular period which should be an ideal period for all the needs of the public or users. And they selected it as 12 months. That's the reason you see every business will prepare their annual statements. Annual ante 12 months. Now the question arises, which 12 months? Technically in a business we follow various years. Like we have a calendar year, Jan to December. We follow financial year, April to March. We follow different years. Okay, but all those academic year is there. So we don't follow all those. We follow, actually there is no restriction as such. In the market you may see different years that are being followed. Many times when we prepare final accounts, we have prepared final accounts as on 30th June, 30th September, 31st March, 31st December. How this is possible? So there is no hard and fast rule that you have to prepare your accounts for up to December, up to March. But many in the market will follow financial year as their year. The reason being, there is a law called income tax law. As per this income tax law, you don't have an option. Compulsory you have to follow April to March only. Preparation of financial statements for a one particular period, its finalization is a big headache for every business. Without errors if you want to tally your balance sheet. Who will prepare two sets of books? For that reason, most will follow their financial year as their accounting year. So that the purposes from income tax law and the Companies Act or whatever the laws you are being covered will be fulfilled. Okay, but in accounting concepts and conventions, principles, please remember that there is no hard and fast rule that you have to follow only financial year. Many people will have a wrong impression. They say that, sir, many companies are following financial year. Is financial year prescribed anywhere? The answer is no. Accounting principles, concepts, conventions never said that you please follow the financial year. They simply said your period of year should be 12 months. Which 12 months? It's your wish. My birthday is in December. I would like to start my accounting year in the 1st December and end on 30th November. Is it allowed? The answer is yes, enjoy. You can have your accounting year like that. No one will stop you from that. But only thing is that keeping the various laws in mind, you have to maintain again one more set of books to satisfy with the other laws. If you are okay with it, you can follow it. But there is no hard and fast rule that you have to follow only this year. But compulsory you have to prepare accounts for annum. Here I'll give you one more new point which you have to understand, that if you look into the market, they'll give you half yearly statements. They'll give you quarterly statements. Maybe in a near future, a time might come they will take monthly statements also. No, it is based on the need. That's the reason I said our accounting is art or science. It's both. Art, according to my need, I am designing it. That's what it is, art. Okay, is that clear? So this is what is your accounting period concept. So till now we have done 4. One is your business entity concept, which says business is separate, businessman is separate. Always you have to think from business angle. Second one is money measurement concept, which says all accounting transactions and events should be recorded in terms of money only. Which money? Currency in circulation, in the reporting currency. Third one is that we have followed was going concern concept, continuously existing for indefinite, not infinite. Fourth one was your accounting period concept. This is also known as periodicity concept, where you have to prepare accounts for 12 months. Then one of the greatest assumption that we have is accrual. Many people don't have a clarity on this accrual. What do you mean by accrual? Accrued ante due, outstanding, arised. Generally what happens is a transaction will have 2 phases. One, accrued stage. Second, the actual money coming in, money going out. Let's take an example. If you take a income, first income you earn, then you receive it. If you take an expense, first you incur, then you pay it. But if you look into the market, it can happen first that you pay, then you enjoy that. First you receive, then you earn it. Anything can happen in a transaction. So it is not hard and fast rule that in a transaction first there should be accrual, then there should be a receipt or a payment. It can be either way around also. First there can be an accrual and first there can be a receipt and a payment, then it accrues. So anything can happen first, keeping in various types of the transactions that we see in the market. So the question arises when it has to be recorded. So this accrual concept will tell you that it has to be recorded the moment it has been accrued, arised, outstanding and due. The best example to understand that is, in our trading account we write sales. We write both cash sales and credit sales. So when you write both cash sales and credit sales, cash sales, sale completed, you got cash. Why you are writing a credit sale? Did you complete it? Yes. But did you receive the money? No. But it is accrued, so you have to write it. Similarly, when you write expenses, whenever there are some expenses are not paid, we write in the form of outstanding expense. Outstanding means accrued. And this concept also can be clubbed with periodicity concept, where periodicity concept says you prepare accounts for a particular period. So in that period, whether it is paid or not, if it is accrued, you are supposed to write. That's how you can couple the concepts and you can understand. These are the first 5 concepts that we have, which has got a universal application. It can be applied for every item of expense, income, asset and liability. The next 4 concepts are very specific concepts which are applicable for a specific item, like realization only for income, cost only for assets and expense. Okay, like that. So first we'll finish off here first. This is a part 1 of your accounting concepts and conventions. In part 2, I'll deal with the rest of the 4 concepts and 3 conventions which we have. Okay, thank you.